Good morning, boys and girls, ladies and gentlemen. Andrew Cady here. Welcome to the Monday market update. We are absent of our trusty partner, Nash Paradise. A little under the weather today, so hope you feel better soon, Nash. Let's dive into the market update. What happened last week? Honestly, guys, markets were pretty well behaved last week for the amount of negative data that we got out of last week. Actually really well behaved. I had a sneaking suspicion that this chart would look the opposite. We would start the week at 6.45 and end at 6.75, but we actually had, instead of a high volatility week, we had some intraday volatility, but overall was a pretty calm week, which is rather surprising. So let's dive into what data came out last week. Market moving data was just across the board, guys. Like everything we could deal with really started on Wednesday with a really poor 10-year treasury auction. And that really could have sent markets into a spiral, but markets took it in stride. And you're going to hear me say this a lot. Markets took it in stride. And again, it was impressive what markets actually held together last week. One of the big items that Nash and I talked about last Monday that was kind of going to be the sneaky thing was the FOMC minutes. Basically the Fed meeting minutes were released on Wednesday as well. And those meeting minutes were not friendly. There was basically, if you don't know what meeting minutes are, corporations, things like the Fed, there's someone that actually sits and transcribes the meetings they have. And all of that gets released. So we actually get to see deep insight into what the Fed is talking about in these meetings that isn't part of their press release and the press conference afterwards. And there was a lot of conversation about the possibility of having to hike interest rates if inflation would continue this higher trend. So I would have thought with that data coming out, markets would have really reacted negatively, but again, they took it in stride. Thursday, we got the personal consumption expenditures. This one really didn't move markets, but there was no expectation of that to move markets because this is February's data prior to the conflict with Iran starting. So no real big movement from the PCE measurement of inflation that we saw come out on Thursday. Initial jobless claims came in a little bit higher than expectations, not significantly. Expectations was 210,000, actually 219,000. So not a huge thing there. And then GDP actually came in a little bit softer than expectations. Consensus was 0.7% increase. It actually came in at a 0.5% increase. So really not a lot of market moving data that we saw come out on Thursday. But Friday is when we got the big CPI report. And this is the one that I've been talking about, as all eyes have been on this report. And fortunately, it came in exactly in line with expectations. The expectations were that we would go from 0.3% rise on the headline CPI to 0.9%. Now, annualize that out, that's a really high inflation rate, 8-9% annualized rate. And it came in exactly in line with expectations, rising 0.9% on a month-over-month basis. And if you actually strip out the food and energy costs, this may have been a little bit of our saving grace. Really, let's not even say the word food. Let's strip out energy costs because that is what this increase is about. The previous report for February was at 0.2% month-over-month increase. The expectations for March's CPI report, excluding food and energy, was that it would rise 0.3%, and that came in under. It only rose 0.2%. And that honestly might have been a little bit of the saving grace, is investors were able to look through this report and say, hey, this conflict in Iran will end at some point, and energy is the driving thing behind it. In fact, core inflation came out less than expectations, and that may have been our saving grace as we walked into it. So last week, a ton of market moving data, but the markets really reacted well to it. So let's move forward into what we got coming this week. This week is an entire week of a nothing burger when it comes to actually market moving data. Really, the only thing that I think we could see be market moving is the producer price index that's going to come out on Tuesday. So let's dive a little bit into the producer price index. Sorry, I'm going to look over here because I have it pulled up over here. This is expected to have a massive, massive increase. Previously, it was at 0.7% increase on a month-over-month basis, which was really hot compared to the expectations. The previous report came in way over expectations. This one, they're expecting that to go from 0.7% increase on a month-over-month basis to 1.2% increase on a month-over-month basis. That's like a 13% annualized inflation rate. That's really, really high for PPI. So I do think there's a lot of room we could miss to the downside there. That's a huge, huge jump considering we were already hot on the last one. So I do think we have a room we could miss on the low side of that. If for some reason it would come in over 1.2%, we probably will see a sell-off in the markets, rates rise, and not be in a good spot. However, if you look at, again, excluding food and energy on this, it's expected to remain flat with it where it was last month on the core reading, which would be a 0.5% increase once again, which is still way over what the target is of 0.2%. And keep in mind, producer price index, this is what companies are paying to produce product that ultimately the consumer buys. So this is almost a little bit of a forward indicator into what future inflation will be for the consumer. It's because if producers are increasing their cost, it's very likely, it's almost possible, or it's almost guaranteed that that will be passed along to the consumer at some point. So besides the PPI report on Tuesday, kind of a whole bunch of nothing burgers. We got initial jobless claims, continuing jobless claims. Those typically haven't been big market moving things. So I think this week it's going to be a lot on technicals, on what the technicals are in the market, and a lot of the news coming out of this conflict with Iran. What oil prices do, whether the Strait of Hormuz actually gets opened. We'll actually begin to see that. Let's move on to the next slide. The Fed's funds rate. Now, this has actually shifted just a little bit, which is kind of interesting. We were initially predicting no rate cuts even in 2027 at one point, or barely. And it is moving up. The probability is moving, kind of creeping back, that we might see a Fed rate cut like 2027 March, like a 30% chance of it, which is higher than we were looking at last week. So it's good to see this kind of moving back in that direction. And I do think this is just sentiment from the fact that core CPI is actually lower than expectations when you strip out the food and energy. And if this conflict can end in a reasonable time frame, we might get back to just business as normal. So investors are feeling a little bit better, not a lot better. We're still up for 0 more rate cuts this year based on the predictions for the Fed funds rate. And I think that is, now let's dive into last slide, mortgage rates. This is a good chart, guys. I mean, we saw this tick up almost to 6.75%, and we've backed off of it, back down to about, call it 6 3/8 for the fixed 30-year rate. Now, keep in mind, this is based on where lenders are locking at. And I believe Nash brought this up a couple weeks ago. And it's important to understand that a lot of consumers aren't seeing this. Number one, this is the ideal consumer scenario. This is a 25% or greater down payment on a primary residence with a very high credit score, which is not every consumer. If you're in the mortgage industry, you know this. So a lot of consumers are seeing that 6.5, 6.75 based on their financial situation. But this is also a bit of a skewed chart, in my opinion, because I think a lot of lenders have been floating interest rates. We know it. I've spoken with CEOs of pretty large wholesale lenders that they talk about how much is being floated out there. And as the market starts to move and we see a little bit of betterment, lenders are discounting, or they're not charging the full amount, and they're basically locking these not at a loss per se, but at lower profit margins. So really that 6 3/8, it might be a little bit kind of underinflated just based on where lenders were floating too much and they're trying to get these loans locked in and taking a little bit of a haircut to get it done. As we go into this week, I think we're in for probably another good week in markets. I think we've got opportunity for this thing to actually kind of go on the good side as long as the news cycle can stay on top of it. If we look at where markets are at today, just taking a peek real quick at uh, where mortgage-backed securities are, we've broken this morning right above the 200-day moving average, and we're kind of battling that. We've been above it for a while this morning. Right now, we're sitting on it. If we can convincingly close above the 200-day moving average, there's a possibility we gain another 20 basis points before we hit the 25-day or 50-day moving average. So I do think we could be in for a good week as long as the news cycle stays in check. So keep an eye on things. If you're floating loans, make sure your clients are the ones driving that forward and not you. You should never gamble with your clients' money. They should only be gambling with their money at your direction of saying, hey, I suggest a lock, but it's your money. You do what you want with it. Appreciate you guys joining in today. Let's go out, have an awesome week, and take care.